Well, we prepared for an explosive move in the Russell 2000, but holy moly, today history was made. So we're going to talk about that, give you some more insight into some of the things that I'm specifically seeing, and we're going to get into the current market conditions for the S&P 500 as well as the Qs, all that and more on today's Stock Market Brief Show. Make sure to hit that thumbs up. It's greatly appreciated, and thanks for all the smiley faces in the last video. Thanks for showing up and showing out. Let's get into it. All right, ladies and gentlemen, welcome back. We're looking at the Ruddy RTY Russell 2000 on the weekly time frame. So we knew that price action was getting tight, so much so that we made a separate video about it on how the Bollinger Bands were contracting incredibly tight. And this is where you can see explosive moves, whether to the upside or the downside. We don't know what the case would be, but you can see once we started breaking up, volatility increased and we started moving up and away. Now, so much so that even today had some insane follow through. So this is a 3 standard deviation move. We actually pretty much closed to the penny on a 3 sigma move, which yes, is incredibly rare to happen. If you look at this, this is the distribution curve, right? These implied moves are based off of implied volatility, right? So the expected move is based off implied volatility. There's a 1 standard deviation. You have a 2 standard deviation right here. 95% of the time it closes within this. Almost 100% of the time it closes within a 3 sigma move. And we closed really pretty much right on the edge of that 3 sigma move. And you can see over here, this was posted by Bespoke. History was made today. The Russell 2000 closed at 4.4 standard deviations from its 50-day moving average. No other major U.S. index, Dow since the 1900s, S&P 500 since 1928, and Nasdaq since 1971 has ever closed at that much of an extreme. So pretty cool stuff to take place. Now, I wanted to show you kind of a visual of what this kind of looks like in a way. All right, so I'm taking the PPO right here. I'm putting the settings 1,50, which tells us, how far the price percent oscillator is from the 50-period EMA. This is the IWM up here. Ignore the blue line. That's just the 2200 EMA. I forgot to change that to 50. And you'll see these kind of highlights in pink. And these highlights in pink are just showing kind of where we're at now and looking back to the last spikes we've seen. Underneath us is where we've seen these spikes really in the rate hiking cycle. For example, the tightening of the Federal Reserve in the tightening cycle. And you can see as rates started moving up, I'm highlighting these pink areas. And I've even highlighted a few that we saw when they were flashed down to 0. But I'll explain some interesting facts on this. So if I look back over here at the price percent oscillator, when we get this extended, we're at about 10% from the 50-period EMA. What has happened in the past during the times where we were actually in a tightening cycle? You can see the market moved up high, boom, and then it got faded a little bit. We came up this high and we faded a little bit. We came up this high, we faded, we came up this high. This was actually in the 2021 breakout. We ended up being a bear trap and we faded. You'd have to go back more to the left when rates were basically slammed to 0. And you'll still see, when you get extended, you see some fades extended right over here. It went sideways and then faded. Right here, we fall down. And then it wasn't until going into 2021 where we saw our multiple hits and we kind of just expanded through that 50-period EMA for quite some time. Now, is the market starting to price in the Federal Reserve cutting rates? Is that why we're starting to see small caps start to move higher? Well, it could be potentially that, or it could be a potentially short squeeze. Big traders getting out of positions causing this market to move up. I find this chart to be interesting here that when you are in a rate tightening cycle and then rates are paused, right? Rates are paused right here. You'll notice you typically see more volatility within the market, even including sometimes reaching to highs. You see that right here, much more volatility, and you see moves to the upside. And then over here, you see volatility, right? And you're seeing a move to the upside. Now, what I find interesting here is when they start cutting rates, and actually cutting rates, is when we actually started to see more volatility rise in these type of products. But add another layer, you can take a look at the 10-year, 2-year yield curve, and you can see it's starting to actually steepen here to potentially get uninverted in the near future. And when you line that up with the rate cut, when you line this inversion, which you can hardly see, it was right here, with the rate cuts, we're planning on September. I'll show you that in a moment. But if we do start cutting rates, are we going to see the market press higher? And or are we going to see something very similar to what we've seen in the past? Now, like I said, the market is pricing in the Fed cutting in with a 90% probability that we will be cutting rates in September. We'll see if that's true, right? The Fed is talking about data, right? And they're talking about, the economy slowing and then potentially lower rates. They don't want the inflation to actually get to 2% before they lower rates. If you look at an interesting chart here, like the United States SM manufacturing PMI, I mean, this shows us that we've been contracting here. You can see these little 3 humps looking back 10 plus years or so. And this actually correlates strongly to the copper gold ratio. And the copper gold ratio here on the monthly time frame, you can see these little 3 humps. And you'll notice that this is actually pointing significantly down. Why? Because copper has been coming off. Gold just hit another high today. And if you go back through history on the chart, when this falls, it's never really a good sign for the economy. You can see this going into the pandemic. You can see it over here going into 2014, 15, 16. And you could go back even further to the dot-com bubble, to the financial crisis. It was the same situation where you get these rapid falls to the downside in this specific ratio. Now let's take a look at the Russell 2000 on the daily time frame. And what I find very interesting about this recent run up here in the Russell 2000 is just look down at the bottom of the screen at implied volatility. While price action's running up like this, we actually see implied volatility rising alongside, which tells me, one, the expected moves that we can see in this are going to be greater, and they are going to be. I'll show you tomorrow's daily expected move. But this is a little bit of a warning sign to me, too, for anybody that wants to enter in late. They may catch the move up further, right? I don't be very careful chasing here, but with implied volatility rising, we could see fast hits to the downside as well. You can even see like where the market was falling here. You saw implied volatility kind of falling off. And that's typical, right? Look at the SPY. The SPY has been rising up nicely, but what's implied volatility doing? It's not doing anything like the Russell 2000, right? Well, when we started falling here, implied volatility was rising. Take a look at the Qs. Very same situation. We had the market pull in, implied volatility rose. Market came in, implied volatility rose. And now you see it consolidating, implied volatility is kind of sticking around right there. So this to me is kind of a warning shot for anybody that just wants to like take an oversized position. Volatility has not come off here, and we could see some dramatic moves still, even if that means it's higher. So just be aware of that as we're reaching these, history being made, 3 standard deviation moves. Yeah, we got to be careful here. That's for sure. Look at the daily time frame over here. I wanted to point out the daily expected move for IWM today, or going into tomorrow, is $3.79. That's plus or minus 3.79. That's huge. I could look back like the last trading day, it was 2.46, 2.16, 2.96, 2.97, 1.36, 1.3, 1.2, 1.8, 1.1, 1.3, 1.6, 2.2, 1.4, 1.43, 1.4, 1.5, 1. I can keep going. This is a gigantic implied move, which can take us where? 220.81 to the downside. That's back to where the quarterly expected move is. Or if we want to continue on this move, we can take us up to 228.39. That would be that 1 standard deviation move there within the Russell. So yeah, buckle up. It's getting wild out there. What's driving this? Well, take a look at regional banks. Regional banks has been on a monster run. XBI, some biotech names, also big in the Russell 2000, been on a monster run. These are names that we prepared for breakouts, which we shared in the past. I'm not going to dig too much into that. Let's take a look at the 10-year, 2-year yield curve, because I do find this interesting here as we get into talking about the S&P 500. So the 10-year, 2-year yield curve, it has been steepening here. It came off slightly today. But if you look down beneath us at the 10-year, 3-month, that has actually been inverting deeper. Okay, so this could be why we're seeing a little kind of interesting market behavior. For example, if I look at the 10-year, 2-year yield curve up here compared to the S&P 500, when we became inverted, you can see when we get more inverted, although purple line's pointing down, we've actually seen the S&P 500 rise. And then when you see us start to uninvert, we actually saw the market kind of pause out and correct itself. Right here, paused out while it went up. But what I'm seeing right here, right now, is a little bit different, which is, could be somewhat confusing. The yield curve has started to uninvert more or steepen, and the S&P 500 continues to rally alongside of that. So is this kind of a warning shot, or that maybe the S&P 500 will start to consolidate here in the very near future? Or is this going to start coming back off, or we're going to see even more of a squeeze? Being that we're so extended, I'd say be careful. And with that, we'll get into the market conditions and kind of explain more specifically key levels to eye in on. Now, today's price action obviously was pretty interesting, right? We saw a rotation or continued rotation out of the large mega cap names and into almost everything else. So NVIDIA, Microsoft, Google, Meta, was down on the trading session. And you could see the cues on the 15-minute time frame. It still has this lower high intact, and we still have this higher low here intact. I think we need to be more cautious of a potential change in trend if we break this low, which we have not done. We're below the 5-day moving average. It's neutral, so technically it could be bearish, but right now it's more neutral. And if we get back above it and it starts rising back up, well, welcome back to the continuation of this bull trend on the shorter time frame. Take a look at the SPY. The SPY is still above a rising 5-day moving average. We're not too far off the upper weekly expected move. Tomorrow's daily expected move is actually outside of that at 567 and 66 cents, and we're right there above the week-to-date anchored volume-weighted average price. If we take a look at Gamma, we have the level 5,700 here. That's where traders are reaching for, and they're starting to reach out further now to 5,750, even up way up here over at 6,000 and 5,800 too as well. But I wanted to remind everyone that we do have that OPEX, so I'll go a little bit more specifically into that. Now, if you look at these levels on the screen, you have 5,700, 5,650, and 5,600. We're still above a rising 5-day, and our current Gamma flip line is at 5,580. So as long as we're above this 5,600, 5,580 level, I think that's good for the bulls. Yeah, we might pull down, but I'd still be looking for the dip buy as we're also above a rising 5-day moving average. But really, we've just been kind of pinned in and around this range of 5,700 and 5,700 and 5,600, and then 5,650 being that these are some key Gamma levels. Now, coming into tomorrow, we do have about 13% of that Gamma expiring. Coming into Friday is a bigger option expiration. We have 30% as of now going to be expiring. And where is that expiring from? We're going to be expiring the majority of that from 5,650 and 5,700. So it's going to be incredibly important to pay attention to where traders start to reach after this option expiration. What's on deck for tomorrow? We do got building permits, housing starts. We got some Fed speak. Nothing too crazy, in my opinion. Are these market-moving events? I guess they can be. I'm not putting too much emphasis on these. It's going to be, an hour before the market opens up. Then Thursday, we have some initial jobless claims, Philly Fed Manufacturing Index, a couple other Fed speakers, and Friday, too, some Fed speak. So somewhat more of a lighter week, but we do have earnings season. It's kicked off really this week and then going into next week, too, as well. Thursday, we got Netflix, and I think there's going to be a lot of eyes on that. So far, we've been seeing some pretty nice moves in the banks, and we'll see if that continues off into the near future when big tech starts to report. That's all I got for you on today's episode, everybody. Hope it helped out. See you later.